So as the market recovers and we look at a 10-year bull market, we look at a dramatic first quarter recovery. Stocks obviously have risen. They're not as cheap as they were in the fourth quarter. As we've been discussing, there's value still in the marketplace. And when you're running a long-term portfolio, you have to stay invested. But as the market climbs, we want to make sure we have the ability to hedge risk in the portfolio. Of course, one way to do that is with fixed income, which we have done. There's limited opportunity in the fixed income market because we're still at lower interest rates than what we have been historically. Another area is in hedge funds. Hedge funds, by definition, should hedge the risk in a stock and bond portfolio. Now, hedge funds have not been the best performer over the last several years because the bull market has run so dramatically. We also know last year, basically everything was down. 94% of the asset classes measured in the market were down, hedge funds being one of those. As we look at the market today and we look at this recovery, we're looking at these hedge funds as an opportunity to diversify the portfolio. Why? Well, as the market matures, these risk reducers should help the portfolio in more volatile times. Another reason is looking at this next chart. This is historical returns of the hedge fund market over the last several decades, going back to 1990. What's important on this chart is hedge funds have never had a 2-year pullback. Now, as you know, we can never say, well, if it's never happened, it never will. But when we look at the factors that go into valuing these hedge funds and determining whether or not they belong in our portfolio, this is just another point that adds to our conviction that, yes, it does make sense to have these in the portfolio to bring down the risk level and try to drive a better risk-adjusted return for the portfolio as a whole. By the way, what we also like in this market, in the alternative space as a hedge, is private equity. Now, private equity is not for everybody. It's a long-term investment. It's illiquid, but it tends to, over time, generate higher returns than equity with less volatility. Now, it's important to note, not less risk, less volatility. Because it's private, it's not in the stock market every day running all over the place and falling to the whims of panic and fear and euphoria as public stock is. This sits on the sidelines. There are businesses, it's debt structures, it's real estate. There's a lot of different opportunities in that market. So our belief is if we're in the right pocket of that market and we have funds that are smaller, more niche plays, that those funds can, again, give us a higher risk-adjusted return in the overall portfolio and hedge the risk of volatility in the public markets.